When it comes to trading, a lot of people do not know actually when to buy or when to sell. In today's video, I'm going to be teaching you exactly how to identify buying opportunities and selling opportunities in the market. My name is Dela. Stick and stay with me on this video. So the first rule you must understand is that you first of all need to identify the trend of the market. In identifying the trend of the market, it is important that we get to understand what market structure is. Now, market structure is basically we understanding how the market moves and then aligning that even into our trading moves. So in this case over here, if we look at this market, we can realize that in this particular area, this market is in an uptrend. That means that the market is moving up. However, how then do we know that we need to buy at this point and we need to sell at this point? Because you need to understand that in as much as the market is moving in an uptrend, it does not necessarily mean the market is moving in a straight line. The market moves up, comes down, moves up, comes down, and there's something what we call impulsive moves and correction moves. Anytime that the market is in an uptrend, the market moves to the upside are always impulsive, and then the market moves to the downside are always in a correction phase. Now let's dive into the chart and get to really understand what I'm talking about. So right over here, I'm going to be looking out for my Eclipse tool so that I can explain to you. Now understand that, as I said earlier, that when the market is moving in an uptrend, the market creates something called higher highs and higher lows. Now over here, we can tell that this is what we call a higher high, right? It means that the market moved from a low point even to a high point, and then the market comes from a higher low and then comes to break above the previous higher high. Now this is giving us a clear indication that the market is moving to the upside. However, I want you to see how the market is clearly creating impulsive moves to the upside. So you can tell that this move to the upside is longer than the one to the downside. So you can tell that the ones to the upside are way longer. If you measure, you realize that this is longer, this is short, this is longer, this is short, this is longer. So it tells us that this market is making more moves to the upside than it is making more moves to the downside. So this is a higher low, this is a higher high, this is a higher low, this is a higher high, this is a higher low. Now over here, we have what we call the impulsive moves, and this is a correction phase. This is an impulsive move, and this is a correction phase. This is an impulsive move, this is a correction phase. This is an impulsive move, this is a correction phase. Now using this basic understanding, this gives us a clear example that this market is in an uptrend. Let's look at the other example if the market is in a downtrend. Now clearly when the market is in a downtrend, we are clearly going to be looking at the same thing, just the terminologies are going to be changed. So in the case of a downtrend, we are going to see the market showing us different indications, just that in this case the terminologies are going to be changed. So right over here we can see a lower high and this is a lower low. It means that as we are descending, the area beneath is getting lower. This is what lower high, and this is the lower low. Now if you look on the downtrend, you realize that the moves to the downside are more than the moves to the upside, meaning that the moves to the downside are more impulsive. Look at the correction, impulsive. It's like it's easy to drop, impulsive. So we can see another lower low, a lower high, a lower high, a lower low, a lower high, and then it continues that way. In this particular fashion, once we identify this, then we can understand when to buy. Then we can understand when to buy or when to sell. Now we need to understand that anytime that the market is in an uptrend, it is important that we catch the market just when it's about to move to the impulsive side. So understand that anytime there's an impulsive move, there's going to be a correction, and after a correction, what's there going to be? Yes, of course, an impulsive move. You got that right. So right in this case, we are going to be looking at how the market on an uptrend moved impulsively. Now we are not going to be catching the moves on the market when the market is already in an impulsive phase, but we are going to be catching the move of the market when the market is in a correction phase. But we need to know how far that correction is going to be. That is why we have things like chart patterns, Fibonacci, and a lot more, which we'll be delving on into this class. But for the purpose of this video, we are going to be discussing when and how we must be selling and buying in this market. So when it comes to buying in the market, we want to be catching the market in an uptrend at the higher low area. So it means that this is the higher high and this is the higher low. So at a higher low area, we want to be buying in the market. So at a higher low area, we want to be buying in the market. we want to be buying in the market at a higher low area, right? And when it comes to a downtrend, we want to be selling at a lower high area, right? So it means that when the market, after forming an impulsive move and a correction, we anticipate another impulsive move to the downside. Therefore, we decide to sell at the lower high, right? Now, this is just the basic market structure that gives you an understanding of when to sell, because a lot of people, you first of all need to even know where exactly your higher highs and higher lows are before you can now start inputting certain things like Fibonacci chart patterns, and then you can align them with market price action or market structure to be able to determine whether this is a good opportunity for you to be buying or not. This is giving you a clear basic foundation into understanding why you should be buying at certain areas. And now let's just delve exactly into the chart, and let me give you guys an example. Now, if you look at this gold chart, right, this happened over the week recently, right? You can tell that from this particular area, this clear area over here, you can tell that this market has been pushing, to the upside. The market came all the way here, came from a higher low, came all the way here from a higher high, a higher low, right? A higher high, a higher low, a higher high. And then what do we see? We see the market down beginning to retrace downwards, right? So you realize that what was happening over here, you realize that things were very easy. Like if you look at it clearly, if you have this chart over here, you can tell that this was a high. These are the impulsive moves, right? These are the impulsive moves. So just when we see this impulsive move, a lot of you will begin to start buying, which is wrong. You first of all need to wait for that correction phase, and you need to see some kind of exhaustion or some kind of Fibonacci exhaustion or retracements, giving us indications that this market is about to continue any further. And after the market has gone up again, we need to be looking out for corrections and then continuations, and it continues like that. Even when the market is about to change and the market is failing to continue any higher, when the market begins to show us signs that the market is reversing, then this gives us a clear understanding into knowing when and how we need to be selling on the market. Let's look at a very clear example over here. Now over here, we can tell from this market that on this particular point, this market has given us clear examples of higher highs and higher lows. So we can see this market came over here for higher highs, higher lows, higher highs, higher lows, and the market pushed all the way over here. I told you guys that when it comes to the market in an uptrend, it is important that we know that we buy at the higher low areas, right? Now you can tell that just when the market formed a higher low, the market began to buy. Now this is giving us a clear understanding that this is a region where we must be looking in for buys. However, it does not necessarily mean that we are just going to be forming higher high and higher lows and then we are going to be buying from them. There are other strategies that are going to help you to know whether this is the right time, the right opportunity, and the right confirmations and confluence to be able to allow you. And as I said earlier, certain things like Fibonacci retracement tools, certain things like candle chart patterns. And let me give you guys a clear example. So for example, if I want to pull up my Fibonacci, right, from this particular area, from this previous high to this previous low, you realize that this particular Fibonacci falls in within the 61.8 and the 78.6 region, which happens to be a magic box area. Especially for those my students, you understand what a magic box means. It simply means that area of confirmation. Now if you scale down to the smaller time frame, let me get back. Now, if you scale down to the very small time frame, you realize that in this particular area, you are going to find some kind of confirmation. Now, in this case, our confirmation over here is going to be a strong candle confirmation. Now over here looks like a morning star. A morning star is an indication that the market is about to reverse even to the upside. So over here, this is where our trade is going to be, and the golden area is going to be our potential take profit. We are going to have our stop loss right below the reason why we are entering the trade, and we are going to allow the market to do what it has to do, and eventually this is going to go in a way to give us some really good profit. Now if you look at this particular trade, this was a beautiful opportunity for us to make some really good amount of money. Now look, this is we risking about 50 pips to target 460 pips in the market. If you are using a lot size of 0.01, you would have made about $46. If you had used the lot size of one lot, you'd have been making close to $4,600 on the market, just by understanding that when it comes to the swing point perspectives of the market, understanding market structure is important. Thank you guys so much for watching this video. I'll see you guys in the next one. My name is Della. Peace out.